Where do mortgage rates come from? That's a question I get often from people. And this question sort of reminds me of the question that we as parents get from our young kids when they're probably 7, 8, 9 years old. Mom, Dad, where do babies come from? And the answer is both simple, but also complex. And it's the same way with mortgage rates. And there's always a lot of misinformation out there. I mean, I have seen, heard, read thousands of ads from my competition, from other mortgage companies, telling you the Fed just lowered short-term rates, implying that mortgage rates dropped. That rarely happens. But they're not telling you the truth of what really is happening. And so in today's video, we're going to cover the 7 players or things that can impact mortgage rates. And so in the very first one is Treasury securities. The federal government is always, offering up, especially 10-year T-bills and then 30-year Treasury bonds, and those are direct competitors that help set mortgage rates, but they don't always go in the same direction. About 25% of the time I'll see Treasury rates dropping and mortgage rates rising, or I'll see mortgage rates dropping and Treasury rates rising. So it's not always totally correlated. About 25% of the time I would say it's not correlated. The second factor, and by far the most direct impact on mortgage rates, most people don't realize there's a security called mortgage-backed securities, or MBS, or more easily known as mortgage bonds. And mortgage bonds are sold on Wall Street from 7:30 in the morning to 3 p.m. in the afternoon every day. And they're traded, honestly, just like stocks are. And so what impacts those prices we'll cover here in the third tip, but just know this, that there's actually mortgage bonds, and that's what most directly impacts mortgage rates. My third tip is realize that the prices of both Treasury securities and mortgage bonds change constantly every day. And so, the prices and rates can go up and down. There's days I'll have, some days I just have one set of rate sheets. Other days I may see 3, 4, 5 sets of rate sheets or pricing. And there's times where pricing just plain goes away because the market's moving so fast, usually in the wrong direction. But what it really truly impacts the yields or rates that people pay is investors' long-term expectations about inflation. Because inflation is the arch enemy of bonds. And so if you own any type of bond like 10 years or longer, inflation is your biggest risk. So if you believe that inflation is going to be low long term, you're willing to accept a lower yield on your return. So you'll pay a greater amount of money to accept that lower rate. Because realize with bonds, higher price means lower rate, lower price means higher rate. But if investors, whether it be private individuals like you and I, mutual funds, ETFs, believe that inflation's going to rise, they're going to be selling their bonds and wanting to get out of the market, thus interest rates or yields rise. And so that's the third thing that really directly impacts mortgage rates. And if you like what you're hearing, please, go ahead and subscribe down below. The next tip, the next thing that can really impact mortgage rates is economic news, especially reports like this Friday, for example, is the monthly jobs report that's coming out. And then also is inflation reports like the producer price index, the consumer price index, or the Fed's favorite inflation report is the PCE. Those reports can move the pricing and rates on mortgages, okay? Fifth one is the stock market. A lot of times there's a yin and yang relationship between stocks and bonds. So if stocks are having a really good day, the Dow or the S&P's up 2% or more, usually mortgage bonds are down and interest rates may be rising that day. But the opposite is true as well. If the stock market is down 2%, often that money goes from stocks into bonds. And when that happens, interest rates may drop, or you'll get a better price on your mortgage that day. Okay. Sixth tip that I want to cover here after I, ask you to subscribe, and like this page, share this page, is the Fed's words. The words from the Federal Reserve can have a huge impact on where mortgage rates go. I know, especially Fed Chairman Powell, his comments can really drive the market. And it was interesting, his testimony in July to Congress, to both the House and the Senate, he made it very plain that any type of tapering isn't going to happen anytime soon. And it looks like that the Fed really wants mortgage rates to remain below 3% for the rest of this year, which is good news for us and for you if you're looking to buy a home. Finally, the last thing that can really impact mortgage rates is the Fed's actions. Back when COVID started in March of last year, the Fed started doing what's called massive amounts of quantitative easing. Basically, they're buying a huge portion of all the mortgage bonds being issued, and in a way, they're basically printing money. Last year, the Fed purchased $2 trillion of mortgage-backed securities or mortgage bonds, and that drove interest rates down into the twos. This year, they've been saying they're buying $40 billion a month of mortgage bonds, but they're buying a lot more than that. I know the experts at MBS Highway did a deep dive into this at end of July and discovered that through June, the Fed had purchased nearly $700 billion of mortgage bonds, or over $100 billion a month. So the Fed's actions and their words both have a direct impact on mortgage rates. And so it's something that I have become an expert on because I want to help you make the best decision on when to lock in your interest rate. And so, if you have questions, please ask me down below, especially if you're an economics geek like me. Please make comments, ask questions down below, and please like and share my video.